Hey, it's me, Ryan Strug, bringing you another Anarchist Bets video. This time I want to talk about assets, the wonderful word they throw around in finance a lot. The different asset classes, the different things you invest in. They're like, well, how do I make money in the world? Well, often you buy assets, and you do that by taking money that you have and spending it on things that will potentially make you more money in the future. This idea came about. I was at a happy hour with some coworkers. I just want to drop a ton of terminology as quickly as I can in like 5 minutes. Look up all these words later on, and you'll see tons of research by a bunch of different people on how to think about these different things, and maybe you can figure out how to make some money, start a business. So here we go. Cash. You have cash. Cash is the most fundamental asset in today's economies, I think. Everybody knows what it looks like. It has value to everybody, and it actually loses value over time when we have inflation, and it gains value when we have deflation. Most people want you to acquire other assets, not use your cash, and hold on to your cash. So they want it. Most economists want economies to always be having inflation, so you're not holding on to the cash and you're investing in things. That may have been improper grammar. I don't really care right now. Let's see. So most people, when they think investing, they're like, oh, let's go to a stock market. Let's have some stocks. Let's go buy stocks in public companies. Okay, but there's also other types of stocks. There's private companies, and a million other things to invest in. Basically, a stock is a form of arbitrage. What you are doing is you are buying, and this is the way 99% of people think about stocks. You have your stock you buy for $10, and you think it's going to go up to $15 in 3 months. You are using arbitrage over time instead of space. Bring a little physics in. You have time and space, right? It's space-time. In arbitrage, you take a product from one location, let's say in Europe, and you bring it over into America. Actually, a better example that's more realistic. You take one product from China where you made super cheap, and you bring it over into America and sell it for a marked up price. And you make so much more money. You make all that extra margin. You're basically doing the same thing with the stock. You're just doing it over time instead of in space. And when you do it in space, if you make something in, say, America and want to sell it in China, and you manufacture it in America, you're not going to get that same markup. As a matter of fact, it's probably cheaper in China. So if you do that by bringing the stock or the product over into China, you're not going to make any money. You might even lose money. The same thing applies to stocks over time. It might go up, it might go down. We don't have a lot of school of thought on that about what happens during time. Actually, we do. Fruit, vegetables, farms, you have seasons. Certain seasons, Christmas trees, for instance, because tis the season. You have all your Christmas trees have flooded the market in December. There's going to be no Christmas trees in July. There's going to be no demand for Christmas trees in July, but there's Christmas trees now. The same thing applies to stocks. It's just there's not a lot of, this pharmaceutical company is going to be valuable in third quarter, Q3 or Q1. Not a lot of people think about it that way. So I thought it was interesting. I wanted to bring it up real quick. Let's see, because I am taking way more time than I thought I would. Let's see. All right, so the other popular investment is gold, metals, and commodities. You have oil, you have natural gas, you have all that stuff, energy. I think Enron was famous for commodities. Isn't that a great story? Let's see. Indexes on stock markets basically keep track of these. They keep average prices over time for commodities and stuff. Those aren't the actual products. What you're basically doing is you're buying products and selling it at a higher price later on or a lower price if you want to get rid of it. Just more assets to buy. I will come back to that in a second. I'm jumping around. Your products, basically. You have store shelves full of stuff. Basically, you are carrying out arbitrage. You are taking one product that you can manufacture for way cheaper, maybe because you are a big company, you have economies of scale, or you can transport it from one location to another and somebody else can't because you have a huge transport ship. Or you just happen to make it yourself, you handcraft it, whatever. I mean, it's the same thing, it's just on a smaller scale. You buy all these products and you sell it on a store shelf, you sell it on eBay. Here's another time example. I have a collector's edition, StarCraft 2, Legacy of the Void. I opened it, so it lost some value because I don't intend to sell it. But if I wanted to sell it, I could buy it when it's only available right before the game comes out, and it's all in the nice wrapping and everything, and I sell it 5 years from now when they don't make these anymore. They don't make them for 4 years. The value is going to go up, theoretically. Because if StarCraft 2 is still a huge game in 5 years, people are going to want it. I'm going to say it's probably not going to be, but there are some games that are like that. You can sell this stuff on eBay. You can if you can't afford a commercial property, have a storefront, you can sell stuff on Amazon. Be careful about property zoning laws and stuff. You can't run a business out of your house sometimes, and sometimes you can. It's interesting. Let's see, bid-ask spread. You have a stock price, you have a product price, you take a look at the market, it goes up and down, you only see one price. You're like, what is the price of Google right now? Well, it's probably like $600. Actually, Apple's a better example because I know that a little more closer off the top of my head. It's like $100. You have your $100 Apple price. That is what I believe is the last price the stock sold for. Basically, you have what is called a bid-ask spread. You have all of the asks, which are what sellers want to buy, all of the asks are what buyers want to sell a product for. They're asking for, let's say, $110, $105 for the particular product or stock. And then you have all the bidders that are like, well, I want to buy it, but I only want to pay $95 or $90. So you have a bid-ask spread. You have all the bidders that are a little bit lower and all the askers, which are a little bit higher. And when they happen to meet, a sale happens, a transaction happens, and that's your stock price. That is your product sale price. You can also think of it as supply and demand. So more words for you to look up later in an encyclopedia or a dictionary, or other research on the internet. Services, you can think about it the same way. With bid ask and all that. Like, everything is related, I promise. You just gotta think about it. You have companies are assets as well. Like, a lot of people think stocks, right? Because you have the price, it goes up and down. But companies, they have these things called revenue. They have these things called expenses. They have profit. They make money over time. Stocks also have dividends. That is a very similar concept. It's just paid out to the shareholder. Companies can also do share buybacks, but the key thing is when you buy a company, and often you have to buy the entire company or get a majority shareholding, you are getting that asset's profit, which you can use later on however you want. This is what Buffett does. He buys lots of companies, he gets tons of profits, and he redirects the profits around his little corporate empire, and he buys more companies, and those are his assets. That is what he buys, because he's way up there on economy of scale. You can think of it as like a machine. A machine takes a raw input and churns out a nice manufactured output. That is better. They made a particular thing better. Something to keep in mind, I didn't write this down, but certain products lose value over time, especially technology. So, like, if you have a car, I think the popular phrase is if you drive it off the lot, it's going to lose value. But if you buy an old clunker and then you put a bunch of parts into it and you do it well, this is really hard to do, by the way. You really have to know what you're doing. it's hard to me at least, you can make it way more valuable than it was before. Because parts and labor. It's not just the parts, you're also doing the labor. And you got to make a little profit. Let's see. Mortgages. Mortgages are assets. I would love to see a mortgage 2.0. Hopefully that comes out soon. And what I mean by a mortgage 2.0 is you have a mortgage where you're like, oh, I'm living somewhere, I have to pay this anyways, but I want to make a little money on top of that. Like, when you pay down a mortgage, you slowly gain equity in your home. If your home keeps its value or increases, you gain the difference between the mortgage that you have left to pay and the price of your home, which is why the financial crisis was huge, because that didn't happen anymore. Your price went below how much mortgage you had left. So all that money you spent went away. All that paper money with the equity went away. But that is the general idea of a mortgage. If there were more investments like that in the economy, so many people would be more well off and more diversified. Diversify, that is another key word. I highly recommend you diversify everything. By knowing all these different assets, you will be able to diversify. So if there were more ways to diversify beyond the mortgage, a lot of people would be a lot better off. So I'm thinking about something like that. If anybody else can think of something, I would love to hear it, because you know what? Let's make this economy robust. Let's see, 4X. You can buy other currencies. You don't have to hold on to just the dollar. I mentioned cash earlier. You can invest in the yen, the renminbi, the won, the euro, the pound, the Australian dollar, Canadian dollar, the peso, and other fun currencies. Basically, the idea is you think that asset's going to do a little bit better over time. It's the same thing with arbitrage. That's exactly what it is. It's just arbitrage. Arbitrage, 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 arbitrage. ARBITRAGE. That is a very important word. That is like pretty much business in a nutshell. All right, a little more complex. We have derivatives. Derivatives, you have option contracts. You can buy the option to buy something later on. So instead of paying for it all outright, you spend a little money now, you get first dibs on it, on a particular asset later on, and you can buy it at that price you agreed to when you bought the option later on, or you can sell it later. I don't want to get too much into it, but basically the put is the short version, and the call is the long version. Long means you think it's going to go up in value. I may have confused myself. I think I'm right, so I highly encourage you to look it up later on, though. And short is the you think it's going to go down in value, so you short it that way. I don't have time to think about it, but I'm 99% sure the call is the long and the put is the short. Let's see, CMOs and CDOs. This is what caused the financial crisis, supposedly. So you had a bunch of mortgages. The banks owned the mortgages from their side. That is investment income that's coming into them. Loans. Loans are those assets. That's what a mortgage is. It's a loan. Basically, you loan out the money. You're going to get that return of money from the other person. So they took CMOs, which are collateralized mortgage. Oh my gosh, I don't remember what the O means. Obligation, I think. CMOs. So you take 100 CMOs, you put them together, and you sell investors on that. And the idea was you're diversified over the CMO, because you don't have to worry about a mortgage going bad, because it'll only be a couple mortgages that go bad. It won't be the whole thing, because you're more diversified, which is why it was really funny when everybody was like, oh my God, how did you not see the financial crisis coming? Because it was diversified. That was the fundamental idea behind the CMO, is you're investing in 1,000 mortgages and maybe only 2 go bad. And instead of being stuck with the only 2 that go bad, you're balanced out. I think the biggest thing with that was you ended up buying CMOs where they were all junk mortgages instead of just a couple. That's kind of how mutual funds work as well. Hedge funds, you take a couple risks on some high return, high risk investments, and but mostly you're kind of safe in a lot of stuff. And that is the general idea behind that, I believe. Though there are often other investment strategies, of course, and I am not a registered securities whatever. So take that as a grain of salt. Should always take everything as a grain of salt, especially if you hear it anywhere, not just the internet. The internet is just an extension of us. But anyways, the overall category for the CMOs are the CDOs, which are collateralized debt obligations, which is what a mortgage is. It's debt. Another form of derivative is actually an insurance, and you know insurances already because you buy car insurance, you buy health insurance, you buy all that jazz. That is a derivative. A fancy derivative that if you had known about at the financial crisis in 2008, that would have made you a lot of money is a credit default swap. John Paulson, a very famous billionaire, he made a ton of money in the financial crisis by buying tons of credit default swaps, which are basically if somebody defaults on a loan or an obligation, they pay, the insurance company pays the money out that would have been paid already, or whatever you agreed to. Maybe you agreed to a little bit less, maybe 50 cents on the dollar. But that is money that you wouldn't have had at all because they defaulted. So the idea is insurance, those are assets. Your car insurance and your rental or home insurance, those are assets. They count as assets. So if you want to look up more information on assets and see what companies' assets are, they have these things called balance sheets. They have assets, liabilities, and equity. I don't want to get into liability and equity at the moment. Basically, it balances out. That's why it's called balance sheet. Yes. Anyways, so look at those assets. Go to the SEC.gov EDGAR system, type in a little stock ticker, or look at the company name. Look at the 10Qs and the 10Ks. The 10Qs are the quarterly statements. The 10Ks are the annual statements. There's a bunch of other documents as well that have lots of information. Those are the two that usually stick out in my mind. And they have what are called the balance sheets. They tell you what all the assets are, the liabilities, and the equities. The assets on that list are what companies are buying. Think of yourself as an individual, as a company. What assets are you going to buy? How are you going to use your liabilities to acquire those assets? And how much equity are you going to make from that? Way more complicated than that in the end, I think. But hopefully that is simple enough to be understood. Last thing. A lot of people are like, oh, I want my bank account to have 5% interest, which is unrealistic, but let's say you have it. And that's it. That's all I care about. I just want a good, solid return that's exactly 5%, exactly predictable forever and ever. I just like that average. And you're probably fooled into thinking that that's a really good thing because of compound interest, which as you gain that money, it kind of goes up over time. But the interest, the change is only 5%. What would be really cool, is if you had an exponential line instead. And this is what startups look like. Basically, you have a negative return or even just a barely positive return on your investment to begin with, but then it just kind of goes up. And then it shoots up. It's like a hockey stick. It goes whoop. So, do you want just like the compound interest, the flat change? Do you want the exponential? So, don't think simple is the only way. Actually, disregard that. Simple is always a good way. Yeah, so just don't think the flat 5% and then I'm happy. Then I don't have to worry about it. Take a risk. Put a little hard work into it. When hard work meets success, you make money. It's not just hard work. You got to be successful too. And don't bet the farm. Whatever you do, please do not bet the farm. Diversify. If you put all your money, all your eggs in one basket, and you lose, can you live with yourself after that? It's a bet. It's an anarchist bet.